In this video, we're going to see how you can use LV financials to determine what your early withdrawal penalty from your retirement account would be. To do this analysis, you'll need a paid account. To start off, go to the username drop-down from the top right and go to the My Accounts section. You will need to create an account group if you have not done so already. In the account group, you can add an account. For a retirement account, you might select something like a traditional 401k plan or an IRA plan. However, for the purpose of this example, I'm just going to use the other account type. I'm going to name this account Test, and I'm going to put an account balance of $240,000 in it. It's important that you put the account balance here to what it would be at the time you need to make your early withdrawal. Once you have this information entered, go to the Tools drop-down and go to the Retirement Planning dashboard. Let's suppose that in the year 2035 you need to make an emergency withdrawal from your retirement account. And let's suppose that you're only 30 years old at this time. The retirement length, in this case, is the number of years you have left in your life. So if you're 30 years old, you might suppose that if all goes well, you might have another 50 years left in your life. Now from the drop-down, we'll start off by leaving this at the start year, 2035. We'll suppose that in the year 2035, when you are 30 years old, that you're single, you are not yet retired, you are not yet married, and the amount that you need to withdraw for emergency purposes, we'll say, is $10,000. The growth rate is the interest rate that you expect to gain on your account for the current selected year, which is 2035. We'll leave that at 5%. If you have a job, then you can enter your salary information as additional income here. For the purpose of example, let's suppose that when you are 30 years old, you have a job that makes you $55,000 per year. Now click Submit. Notice that a feature of this dashboard is that the information you enter in the selected year automatically propagates forward in time for the remainder of your retirement plan, which in this case we have specified as 50 years. So when you scroll down, you'll notice that each of these graphs takes the information from the selected year and automatically fills that same information forward for the remainder of the plan. Let's scroll back up. Since we are withdrawing this amount only one time for emergency purposes, we cannot yet use this information to make our decision. So we need to go to the following year, 2036, and set the withdrawal amount to $0, because we're assuming that we're only making the $10,000 withdrawal in 2035, and then in 2036 everything goes back to normal. We have no emergency withdrawal, and our income is still $55,000. Now click Submit to make this change. Once again, the change that we have made in 2036 propagates forward from that point in time. So when we scroll down, for example, the account cash flow plot shows that the change we made in 2036 has automatically been filled forward all the way out to the remainder of the plan. Let's scroll down to the bottom now. At this point, we have enough information to determine what our early withdrawal penalty would be. Because we have only withdrawn 1 year, and we have set the withdrawal at $0 for the remainder of the plan, we can see that the year that we withdrew that money in, we were charged a penalty of $1,000 on that $10,000 withdrawal. You can also see here that your early withdrawal penalty period ends in 2065. So that is the year at which you'll be able to make withdrawals from your retirement account without incurring a withdrawal penalty. You'll also notice here that there is a required minimum distribution that begins in 2077. This is an IRS requirement that you withdraw a certain amount from your account if you have a certain balance and you are a certain age. When we scroll back up, some of the values in these graphs might make more sense now that we know that there is an RMD. For instance, here in 2077, you can see that there is a spike in income. That's because we filled forward in time the $55,000 from our job, which you can see in the year before as the pre-tax income. But now, the RMD mandates that you withdraw from your retirement account in 2077. So you can see that this additional income is coming from that RMD. When you scroll up to the account balance, you can see that it is continually growing over time, except towards the end here when it seems to level off. And when you scroll up to the account cash flow, you can see why that is happening. Because once again in 2077, when you begin making the required minimum distributions or the required withdrawals from your account, your cash flow takes a dive and eventually goes into the negative range as you start withdrawing more than your account is earning in interest. So this has given you an overview of the retirement planning tool and how you can use it to make very specific financial plans for your retirement. And we've also seen how you can use this tool to determine what your early withdrawal penalty would be.